Welcome back. Macys shares soaring to a 9-month high after the department store chain reportedly received a $5.8 billion buyout bid from a real estate-focused investor group. O'Leary Ventures chairman Kevin O'Leary joins us now. Kevin, it's great to have you on the program. Thank you for being here. That would value the company, give it a stock price of $21 a share, which was well above where it closed on Friday, 17 and change. But this is a group that's not necessarily going after the retail business itself, as Macys has been struggling. It appears they want to go after some of those flagship locations. They want that real estate value. I wanted to get your thoughts on this. Is the value there?
Yeah, it is actually. The way to look at it, and this is a little bit of speculation on my part from the private equity side, but I think it's a smart move because what you get to do is cut costs like crazy, bleed cash because you're going to be able to actually have a cash flow from this, while at the same time acquiring these flagship real estate entities, which are very valuable. Now, you also have an opportunity here to digitize, in other words, direct to consumer with Macys. It's a well-known brand. So there's lots of optionality, things you can't do when you're public, because it just is a mess quarter after quarter when you're whipping around costs, cutting, laying off staff, all the rest of that. This is actually when growth is slowed, because Macys basically doesn't grow anymore. This is what happens, and this is why private equity is an important element of the economy. It kind of is the spatula that cleans everything up, and that's exactly what's going to happen here.
Kevin, I'm really eager to get your take on this one. Democrats are introducing legislation to get hedge funds out of the housing market. New reports are revealing big investors accounted for over a quarter of all single-family home purchases in June. Okay, so on the one hand, Kevin, I hate this trend because it makes life hard for the little guy. On the other hand, I just don't want to see the government get involved any more than they already are in regulating housing. Where do you come down on this one?
Very bad idea, very bad policy. When you try and manipulate markets or sources of capital, and because that's really what's going on here, all of these different elements in our economy provide funding for all kinds of different sectors, including real estate, which is the 11th sector of the S&P. When it became the 11th sector, all kinds of different structures, including hedge funds, including private equity, including more speculative family offices, got involved in real estate. And so to actually decide, well, I'm going to pick this source of funding over this one is not what the government should be doing. I don't care if they're Democrats or Republicans, whoever they are. Stay out of the markets. Let the markets be the markets. That's what is so efficient about our economy. When you let it do its thing, it's the lowest cost of capital with the most liquidity. This kind of government policy is very, very bad and destructive.
Well, Kevin, speaking of manipulating markets, I want to ask you about electric vehicles because we have the first taxpayer-funded EV charging station in the country now opening in Ohio. But, Kevin, it's coming 2 years after Biden allocated $5 billion for a nationwide network of EV stations. What does this say about the state of play with our EV infrastructure in the country?
It's way behind schedule, obviously, and it's actually taken back many companies that are thinking about risking capital and building more EVs. I mean, that's what's really started to affect companies like Ford and General Motors. Ford on their Lightning discovered they were losing $23,000 to $29,000 per vehicle. They can't raise it that much higher. They won't sell any. And that's because there's a lot of issues around the market, including charging distribution. Standardizing on Tesla is a no-brainer. Everybody's going to have to do that because they took private capital and built their own infrastructure, which is far more efficient than when the government does it. And so we have an adjustment period occurring here. The market's realizing, and a lot of the green initiatives, particularly spearheaded by last week's big UN conference on climate change, everybody's woken up and smelt the charging station, with their words. You got to deal with reality. The transition's going to take a lot longer. And it's the first time I've seen one of these conferences, because I was there, where everybody said, OK, we get it. It's going to take 20, 30, 40, 50 years. So let's try and figure out that strategy. Let's get realistic now.
Kevin, really quickly, because the government's plans have rolled out so slowly, does that actually create time to just pull the plug entirely? If we get a different administration in 2024, just say we're done, quit it, we're not that far along, give it up, move back to the market?
Well, that would be the pragmatic thing to do. But once you have a bill that's already been issued and the printing presses haven't really even started on that Infrastructure Act, you've got the Chips and Science Act, you've got the Inflation Reduction Act, All of these are very inflationary, and they haven't even started the printing presses yet. And in a way, it's kind of like it's a support mechanism for the markets right now. Everybody knows this money is coming. Whether it gets spent efficiently or not is anybody's guess. And my guess is because it's the government money coming out of a helicopter, there's going to be lots of leakage.
I don't want to find out how inefficient it's going to be. Get rid of them now. Kevin O'Leary, always great to see you. Thanks for being with us.
Take care. Bye-bye.